European and US stock indices are pushing higher in early trade on Tuesday, building on yesterday's gains. Does that mean the banking crisis is over? Keep watching. Hello, I'm David and this is Trading Today. Yes, there's a sort of wave of positivity crossing across investors and markets at the moment, suggesting that maybe the worst of the banking crisis is over. Maybe. Let's just cast our minds back. We have, in the last few weeks, seen the demise of Silvergate Bank, of the Silicon Valley Bank, of Signature Bank, all US regional banks. On top of that, we've just seen the biggest Swiss bank, UBS, forced by the Swiss government to take over Credit Suisse. Now, it did this as a knockdown price, and quite rightly so, but there are concerns that certain bondholders have been wiped out, which could set a dangerous precedent. That may or may not be true. It depends on the kind of bonds that we're considering here. And we also have First Republic, another US regional bank, which has fallen 90% over the past fortnight. There are feelings that this could be saved now because there's talk of JP Morgan getting involved to advise the regional bank, and also it has had a large influx of cash from a number of major US banks. Remember, there is this tiering system over there, and the ones that we have seen fail are not deemed to be significantly important or too big to fail. Now that's that. So that's going on, and there seems to be a little bit of a bid coming in, and we've certainly seen the indices that cover regional banks in the US, they have bounced a little bit yesterday and are looking higher again today. Now, all this is supposed to temper the US Federal Reserve's attitude when it comes to tightening rates. Now, we've got a meeting that starts today, finishes tomorrow. As far as the market's concerned, 83% probability that they will raise rates by 25 basis points. Now, that means that taking away 83 from 100, we have 17%. Now, that 17% is saying no hike whatsoever. So, nevertheless, the market is pricing in 25 basis points rate hike. But what I think is going to be more important is we also have the quarterly summary of economic projections from individual FOMC members. Now, this looks at their forecasts for GDP, for interest rates, for inflation and for unemployment going forward through the rest of this year and beyond. That's going to be a big thing to watch, because at the moment, the market, the smart money on the CME Fed futures, what it's saying is there may be another 25 basis point rate hike in May, but after that, that will see interest rates of Fed funds at 5.25%, which they reckon could be the new terminal rate. And from there, they'll start coming down this year. Just contrast that with what Fed Chair Jerome Powell was saying just a few weeks ago in his testimony to the Senate, and he said that the market had underestimated how much further the Fed would raise rates and how much longer they would keep them up there. That, of course, was before the banking crisis. At the moment, as things stand, recession worries have increased, inflation concerns have decreased. I hope you found this interesting and of help. If you have, please do like and follow. And as always, best of luck with your trading. Goodbye.